Welcome to our guide on International Public Sector Accounting Standard 34, or Ipsas 34. This standard addresses how public sector entities, like government ministries or state-owned companies, should report investments in other entities in their own separate financial statements. Ipsas 34 ensures these statements are clear and useful for understanding the parent entity's financial position, separate from its subsidiaries or associates. Imagine a government department that controls several agencies. It must report its own financial performance, not just the group's. Ipsas 34 sets the rules for how these investments appear in the parent's individual reports, supporting accountability and transparency. Stakeholders, like taxpayers and legislators, rely on these statements to see how public funds are managed. The standard applies when a parent entity presents its own financial statements in addition to consolidated ones. A parent controls subsidiaries, may influence associates, or participate in joint ventures, each considered an investment. Ipsas 34 gives the parent a choice of accounting methods for these investments in its separate statements. This flexibility helps entities present the most relevant information for their users. In this video, we'll break down the key concepts, compare separate and consolidated statements, and show practical examples. By the end, you'll know how to apply Ipsas 34 to prepare compliant separate financial statements. To understand Ipsas 34, let's clarify the difference between separate and consolidated financial statements. Consolidated statements combine the financials of a parent and its subsidiaries, presenting them as one economic entity. Internal transactions are eliminated, showing the group's overall financial health. Separate financial statements, however, focus solely on the parent's own financial position and performance. Investments in subsidiaries, associates, or joint ventures appear as assets on the parent's balance sheet. For example, a city's consolidated statements include its library and water utility, while its separate statements show only the city's finances, listing those entities as investments. Consolidated statements give a group perspective. Separate statements show the parent's individual performance. Creditors may care more about the parent's separate statements since their claims are against the parent's assets. Ipsas 34 sets the rules for these parent-only reports, but preparing separate statements is optional. If an entity chooses to present them under Ipsas, it must follow Ipsas 34 for consistency and comparability. Ipsas 34 offers three ways to account for investments in separate financial statements: cost, fair value, and the equity method. The same method must be used for each class of investment: subsidiaries, associates, or joint ventures. The cost method records the investment at purchase price, adjusted only for impairment. The fair value method updates the investment's value each period, with changes recognized in surplus or deficit. Fair value is based on market price or valuation techniques if no market exists. The equity method starts at cost, then adjusts for the parent's share of the investee's profit or loss. Dividends reduce the carrying amount under the equity method. Each method has pros and cons. Cost is simple, fair value is current but volatile. Equity links value to performance. Entities must choose the method that best reflects their reporting objectives and provides reliable information. Let's see how these methods work with practical examples. Under the cost method, if a Department of Energy invests $50 million in Solar Power Corp., the entry is debit investment in Solar Power Corp, $50 million. Credit cash, $50 million. This records the initial investment at cost, which stays on the balance sheet unless impaired. Using the fair value method, suppose Solar Power Corp's value rises to $55 million at year-end. The entry is debit investment in Solar Power Corp, $5 million. Credit fair value, gain on investment, $5 million. This updates the investment's value and recognizes the gain in surplus or deficit. Under the equity method, the investment is adjusted each period for the parent's share of the investee's profit or loss, and dividends received reduce the carrying amount. These entries ensure the parent's separate statements reflect the chosen accounting method. Accurate journal entries are key to transparent reporting. Sometimes, investments lose value and must be tested for impairment under the cost or equity method. An impairment loss occurs if the recoverable amount is less than the carrying amount. For example, if Solar Power Corp's value drops to $30 million, the department recognizes a $20 million impairment loss. The entry is debit impairment loss on investment, $20 million. Credit investment in Solar Power Corp, $20 million. This reduces the investment's value and records the loss in the statement of financial performance. If the fair value method is used, declines in value are recognized automatically each period. Impairment entries ensure the balance sheet reflects economic reality. Ipsas 34 requires clear disclosures in separate financial statements. Entities must state that the statements are separate and prepared under Ipsas 34, explaining the reason if not legally required. The chosen accounting method, cost, fair value, or equity, must be disclosed and applied consistently for each class of investment. A detailed list of significant investments, including names, locations, and ownership percentages, must be provided. Dividends or similar distributions recognized as revenue must also be disclosed. These disclosures help users understand the parents' relationships and the basis for reported figures. Proper disclosure ensures transparency and accountability. Stakeholders can make informed decisions with complete information.